Hi, everybody. I will go ahead and wait about 30 seconds or a minute to let folks start to come in. Okay, we're at over 100, so I think we're ready to get started. Good afternoon and welcome to this Risk Readiness webinar. My name is Carly Edmondson, Senior Product Manager of Business Solutions at the Risk Management Association. RMA is proud to make this presentation complimentary to members. If you're not a member, explore all RMA has to offer at rmahq.org. Today's webinar is the latest installment of Credit Trends in Commercial Lending, Credit Risk Navigator, presented by Jeremy Chelson from AFS. During the presentation, if you have a question for the speaker, please submit using the Q&A feature at the bottom of your Zoom screen. We will address as many of your questions as we can at the end of the presentation. With that, I'd like to turn it over to Jeremy from AFS. Thanks for joining us today.
Awesome. Thanks so much, Carly. Good morning, good afternoon, or good evening, depending on your location. We're really honored to have you attending this webinar today. We know how busy everybody is, but I think you'll find a lot of really great insights looking at some of the data through April of this year. So the topic today is credit trends in commercial lending. And specifically, we'll be examining things like trends in loan growth, asset quality, and performance for C&I and CRE loans. So for those of you that have joined us, you're probably familiar with the source of today's data, which is the RMA Credit Risk Navigator powered by AFS. The Credit Risk Navigator, or CRN for short, is a benchmarking program that RMA and AFS have been jointly operating since 2003. We hear all the time from banks how challenging it is to get reliable data on middle market loans, specific stats on commercial real estate property types, and so on. And we built this database to really provide credit insights tailored to your footprint, your sector concentrations, and really give you that detail you need to better manage credit through all sorts of volatile times like we're living through now. The analytics, they're delivered via an intuitive, interactive online dashboard that enables you to visualize comparisons versus peer banks. You can see a screenshot of what one of our summary report looks like there on the left hand of your screen. And I think you'll get a much clearer sense for some of the dimensions and the parameters and ways that we can segment the data as we go through the presentation. If you'd like to learn more about this service and how it could benefit your bank, Carly and I would love to set up a demo for you. Our contact information will be at the end of the presentation. So by all means, if you want to learn more or see a demo of this dashboard, by all means, please reach out to us. So before diving into the C&I and the CRE results, I thought it might be helpful to level set with a look at some of the broader economic forces impacting commercial loan credit. Now, this word certainly gets overused in many contexts, but I don't think I ever remember a time when so much uncertainty was clouding the market. So if you look here, kind of working our way from left to right, we have a picture of GDP. And unfortunately, GDP was negative in the first quarter of 2022. That came out pretty recently. That's probably not too much of a surprise. I know with Omicron and some of the restrictions that were put in place, that dented the economy, it dented travel. But since GDP is really a leading indicator of both commercial loan growth and credit quality, not a good thing to see. So certainly a troublesome trend from that perspective. Note that unlike a year ago, no stimulus is taking place right now. So businesses and people are not as flush with capital as they were, say, a year ago. And all this is being compounded by the fact that inflation right now is running very, very hot. You can see in the middle of the graph, thankfully, inflation, it did cool a little bit in April. You can see the trend dip down both for the CPI and then what they call the core CPI, which takes out food and energy prices. But it was still in April way higher than most analysts had expected. President Biden has made fighting inflation his top domestic priority, and the Fed has signaled its intent to act very aggressively to try to curb this trend and bring inflation back down closer to their 2% target. The risk for us in the banking industry, and specifically those of us that manage CNI and CRE portfolios, is that if the Fed tightens too aggressively, that could possibly trigger a recession, which certainly would have ramifications for CNI and CRE asset quality. That uncertainty around what the Fed is going to do, what the economy is going to look like a year from now, or even 6 months from now, really dented small business optimism as well. We have a picture of that on the right-hand chart. An index of 100 is kind of what you might call your long-term average. And you can see that right now, small business optimism has been trending down and is below that long-term average. In fact, according to the survey that supports this index, small business owners expecting better conditions, business conditions over the next 6 months dropped to a net negative of 50%, which was the lowest level recorded in 48 years. So all of this is very concerning in terms of the outlook for the US economy. I will say that the good news for now, for us in the banking industry, is that despite these headwinds, commercial loan asset quality is still really, really good. As you'll see in this presentation, criticized levels have been low. We're not seeing charge-offs accelerate just yet. And I think that's really probably the biggest takeaway through this presentation, that you'll see that despite some of these headwinds that are forming and intensifying, and certainly that we have to be aware of, for now, banks are doing a phenomenal job managing their loan books, and commercial loan asset quality is still very, very good. So speaking of headwinds, the last webinar, we actually surveyed all of you on what you perceive to be the biggest headaches for your commercial borrowers. Overwhelmingly, of the various questions that we asked, the top concern was inflation and the increased cost of doing business. I think this is because inflation really has had the most tangible impact. You know, we see inflation everywhere, right? It's in gas prices, food prices. I got my haircut over the weekend. It was $50 for that. Never paid that price for a haircut before. So we're all feeling that to some degree, and that is certainly going to be impacting the businesses that banks lend to. It's really inflation, what you might call right now a supply side problem, meaning that consumer and corporate demand still is held up pretty strong throughout all of this increase in prices. Unfortunately, that means there's really so much the Fed can do with rate increases to control inflation. In fact, I read that one analyst was predicting that we might have to get used to 4 to 5% inflation over the next couple of years. So if this is a concern in terms of commercial loan asset quality and its impact on lending, we may have to get used to this new normal. We're also seeing banks cite issues, supply chain issues, as being a concern for their commercial borrowers. That's the yellow bar here. Again, more than 2/3 cited that as a big concern for lending. I think the concern here is that supply chain issues could materialize into early stage delinquencies for commercial borrowers. And we'll actually show you a picture of that in a few moments. But the glimmer of hope here is that according to the banks that we surveyed, if you look on the far right there, very few feel that consumer confidence is going to be an issue going forward. As I mentioned, airlines right now are doing pretty well in terms of the demand and the traffic. Retailers, while some consumers are cutting back, it's still pretty strong. And hopefully that could maybe blunt some of the impact of these headwinds in 2022. Now, given the focus on inflation, and since all of you have told us that this is really a focus for your banks, we wanted to see if we could illustrate the correlation between inflation and commercial loan performance. And it's strange to say this, but inflation is actually kind of a mixed bag for banks. Initially, at least, it does tend to spur borrowers to take out new loans. They realize that in the future, material costs are going to go up, or even the cost of credit's going to go up as interest rates rise. And so they do start to tap credit lines or take out new loans. And initially, that can be a tailwind for banks. Now, inflation's relationship with commercial loan asset quality or performance, that's a little bit more difficult to infer. So what you can see here, we plotted a trend in CNI delinquencies, which is the yellow line here. That actually includes both loans that are past due and on non-accrual. And then we plotted the year-over-year change in the core inflation. And what we found is there is a moderately strong positive correlation between the two series. The last time we saw inflation this high was in the 1980s. And you can see that back then delinquencies were indeed higher. That trend, though, did diverge during the last two recessions, the recessionary periods here indicated by that shaded gray area. During the Great Recession and the one that we experienced during COVID, what we saw during these periods were wages declined, we had job losses, big hits to investment portfolios, all of which resulted in deflation, while at the same time delinquencies had increased. To be sure, prolonged inflation can strain an economy and even dip it into recession. And I think that's the fear that we're living with today, that high inflation and high interest rates could hurt businesses and potentially aggravate C&I delinquencies. Still remains to be seen, but definitely a concern that we all have to be aware of and continue to monitor in the months that follow. Now, in terms of these macroeconomic trends, banks are certainly aware of these growing risks, as evidenced by the trend in loan loss provisions. In 1Q of this year, banks switched back into reserve building mode. This was actually the first time in quite a while where we had a net increase in loan loss provisions. A lot of banks in their earnings calls had cited that for some industries like leisure and hospitality, while they are increasing, they're really not back to business as usual. And that perhaps, and coupled with some of the headwinds we were just looking at, GDP falling, inflation still being very high, small business optimism very low, banks have recognized that perhaps the economic outlook is a bit more uncertain, and accordingly, they're now adding to loan loss provisions. This trend, though, has been pretty volatile. You can see that from 2020 onwards, really just how it ebbed and flowed quite dramatically over time. I think a lot of this has to do with the implementation of CECL. With CECL, banks have been required to switch from reserving from incurred losses to expected losses. And what we saw during the pandemic was banks maybe were a bit more conservative than they would have been otherwise. You can see they really added the loan loss reserves early into the pandemic in 1Q20 and 2Q20. But then when the worst case scenario didn't materialize, they actually began to release reserves. That volatility has been somewhat of a criticism with CECL, that we're going to see more of that with loan loss reserves. It's very possible that if we get more certainty or economic clarity later down the road, banks will once again begin releasing reserves. But it's that CECL dynamic that I really think helps explain some of the volatility here. And again, I really want to emphasize, and you'll see this more explicitly in the charts that follow, commercial loan asset quality is still very, very strong. So we're not in panic mode yet. I wouldn't go so far as to say a crisis is imminent, and I wouldn't be that hyperbolic. But certainly the fact that banks are adding to reserves once again does signal, does at least represent that uncertainty in the economy that we're seeing. So what I'd like to do now is dive into the results for commercial and industrial loans. And I'd like to begin actually with a picture here of C&I loan growth. And what we're looking at here is C&I loan growth in each month. It is seasonally adjusted annualized rates, to be specific. What really caught my attention here on this chart, if you look on the far right, C&I loan growth for the industry as a whole has been exceptionally robust in the last couple of months. Now, typically growth does tend to pick up a little bit at quarter end, so I wasn't too surprised by that March number. But the fact that April was still so strong really did catch me by surprise. April is usually not one of the stronger months for C&I lending. In fact, the industry had declined a year ago during that same month. This is not a regional phenomenon. In fact, we're seeing broad-based increases across the country and even by industry sectors. So it's really a broad-based increases across the industry in C&I lending. I think what's going on here, if I had to speculate why loan growth has been so robust lately, I think it has a lot to do with inflation and inflationary pressures. I think it's making businesses invest now with CapEx expenditures before material and credit costs rise even further. So that dynamic is certainly, I think, impacting these trends. That might eventually, as interest rates rise, that might actually discourage borrowing. So it could become a headwind later down the year. But right now, I think it's that inflationary pressure that is supporting that loan growth. It's also worth mentioning too, though, that by some measures, the economy is still really strong. I know that GDP declined in the first quarter, but a lot of labor market indicators, like the unemployment rate, for example, are still really, really good. And perhaps that could be a counterweight in the months that follow, that if the labor market remains tight, that could help maybe sustain loan growth in the months that follow. So a lot of different things driving this trend. I think inflation coupled with a strong labor market really helps explain that really robust pickup we're seeing in C&I loan growth. Now, a bit more concerning trend for the industry is what we're seeing in terms of short-term C&I delinquencies. As mentioned, on balance, C&I credit quality and asset quality is still really, really good, with one notable exception this month. You can see here on this chart. What we plotted on the left is a trend in short-term C&I delinquencies, so loans that are past due between 30 and 59 days, and to kind of smooth out some of the volatility, we also overlaid a 3-month moving average. What we saw this April was an exceptionally large spike in short-term C&I delinquencies. In fact, they reached the highest level they had been since 2020. Now, we should mention, as you can see here, that that trend has been really volatile throughout the pandemic period. I think a reason for that is we're consistently seeing closures, then reopenings, then closures again. We have supply chain bottlenecks that ease and then tighten again. All of those frictions, I think, are really impacting the trend in C&I delinquencies and accounting for that volatility. I really don't want to be too hyperbolic about the increase in April. One month does not make a trend. And as you can see here on this picture, there were plenty of times where it spiked and then the next month it came right back down. But viewed in the context of some of the economic frictions that we mentioned, certainly this is a troublesome sign and one we're going to pay very, very close attention to in the months that follow. The good news is that these early stage delinquencies really haven't migrated to higher stage past dues, nor have they materialized into defaults. If you look on the right-hand picture here, the trend in C&I non-accruals, that actually came down month over month. So that's a favorable trend. In fact, at 65 basis points, the C&I non-accrual rate in April was at the lowest level we've seen since 2007. So the actual defaults, kind of using non-accruals, a proxy for defaults, are still at very low levels. We're seeing a lot of industries like oil and gas and hospitality show significant improvements year over year, and that certainly has helped this trend. So again, the past due increase, definitely we're going to keep an eye on that, but for now, it has not materialized into higher stage delinquencies or defaults just yet, at least. Now, in the Credit Risk Navigator, one of the ways that we can dissect the results is by industry. In fact, we can actually drill down all the way to a 6-digit NAICS code and really give you some granular insights across different sectors and subsectors. And what we've done here, we wanted to get some more color into that delinquency increase that we saw in April. We're looking at the 10 3-digit NAICS subsectors with the largest month-over-month change in short-term delinquencies, ranked in descending order by that change. The industry that really caught my eye here is the second one here, 525 funds and trusts. That's the finance and insurance sector. One of the trends we've been seeing in the commercial banking industry is that more and more commercial banks are increasing their exposure to private equity, venture capital firms, and other organizations that deal with leveraged loans and products. Private equity firms often borrow from banks to increase their dry powder to then make acquisitions. And so that has been a really strong growth dynamic in the market. The concern, though, is that obviously firms that specialize in leveraged loans or deal with those kind of borrowers, even a modest uptick in interest rates can sometimes cause stress in that sector. This is speculating, but perhaps the Fed funds rate or the increase in the Fed funds rate mid-March may have actually stressed some of these companies that specialize in those financial products and that deal with leveraged borrowers. And perhaps that could account for that big increase in past dues that we're seeing for the industry that primarily focuses on those types of activities. We also saw, if you look in this middle of the graph here, a pretty notable uptick in delinquencies for computer and electronic manufacturing. That's just about in the middle of the graph. This again is speculating, but perhaps with a lot of these supply chain disruptions, and I know China's zero COVID policy, that's impacting computer chips and shipments. I'm wondering if that again had something to do with the past due increase, excuse me, that we're seeing in the month of April. So again, a really interesting picture here. And again, we can cut this by sector to give you always more color into a macro trend that we see in the database. Another interesting way in the database that we can display the results is by geographic region. And again, in our service, we have a lot of granularity by geography. We can actually drill down to a state level and even to an MSA level in the database. And what we're looking at here is a heat map of unemployment ratios on the left, and then non-accrual ratios by state on the right. The reason we've done this is because we've observed over time, looking through our history in the database, there's a really strong correlation between the unemployment rate and the non-accrual rate for CNI loans. It's a really good indicator to follow in terms of trying to forecast what might be the path of non-accruals. While the labor market is still strong, the recovery has not been uniform across the pandemic or across the country, that is. Disparity in unemployment rates, job openings, and just general economic conditions, all of these factors greatly influence regional differences in CNI non-accrual levels. In general, I'll say that states with higher levels of unemployment typically also report higher levels of CNI non-accruing loans. There's about a 32% correlation coefficient across those two series. Both RMA and AFS are actually headquartered in PA, and unfortunately, that's a state that has not only one of the highest unemployment rates in the country, but also one of the highest non-accrual ratios. So again, the point here is to demonstrate that monitoring indicators, leading indicators like the unemployment rate, particularly at a local level or a regional level, can help us forecast the path of non-performing loans through a volatile period, such as the one we're living through now. Now, in terms of asset quality, the quality of commercial loan bank portfolios or commercial bank loan portfolios really remained strong through the month of April, despite obvious signs of slowing in the US economy. Here is one measure of asset quality. We plot the trend and composition of criticized loan ratios. So specifically, it's the percentage of balances rated special mention, substandard, doubtful, or loss. Some history here is helpful. We saw a pretty big increase, or a meaningful increase rather, in criticized loans in 2020 at the start of the pandemic, particularly in sectors that were hit really hard by the lockdown, like hospitality and leisure. That increase, though, that we saw during the pandemic period wasn't nearly as severe as the one that we witnessed during the Great Recession. I think that's because of the enormity and the rapidness of the government's response to try to help borrowers and help banks kind of work with their borrowers to manage through all that volatility. Since then, criticized loans have been trending down. I think we're now at a 14 or 15-month rally where they've been declining sequentially over that period. In fact, in April, we saw a really significant result. The April criticized ratio was 5.25% of total outstandings. That is a new service low watermark. So said in another way, criticized loans in April were at their lowest level in 20 years. Much of that improvement reflects some of the normalization that we're seeing in some industries. So again, hospitality and leisure are starting to make a comeback. Oil and gas has rallied, given the rise in commodity prices, and non-accruals and criticized loans in the energy sector have fallen. I also think, though, it might be a function of the ratio here. So the denominator of criticized loans is total outstandings. If you recall from a previous chart, we saw quite a bit of an uptick recently in CNI lending, particularly in the higher end of the market and what you might call maybe the larger investment grade loans. So what happens is if we see loans increase over time, even if criticized balances stay the same, if the denominator, the total outstandings, is increasing, that could bring down the ratio. So it's a combination of multiple things. Some industries are starting to normalize, and we're also seeing quite a bit of loan growth that is resulting in a higher denominator for this ratio. Now, while overall banks, their C&I portfolios are still in really good health, there are some pockets of stress in the industry. Here we illustrate the 5 best and worst industries in terms of their default outlooks. And we're using a measure called weighted average probability of default. And for this particular measure, we're actually excluding non-accruals. We wanted it to be a more forward-looking estimate of default. And again, these are the 5 best and 5 worst subsectors relative to that particular metric. 2 industries in the left-hand chart, which are the 5 worst, really stick out, those being NAICS 483 water transportation, which is really your cruise lines, and NAICS 481, which are the airlines. Also seeing 721 accommodation, which is your hotels and motels, also appear as a negative outlier on this chart. These were among the hardest hit industries during the pandemic. And they're also among the most vulnerable in terms of changes with inflation and consumer spending. Now, we are seeing some signs of these industries normalizing and returning to health. For example, with airlines, I believe it's been a pretty strong year so far in terms of sales and ticket sales. Same thing with hotels and leisure in some parts of the country. We're seeing, for example, around in Florida, around Disney World, a lot of hotels pick up in that area of the country. Again, anywhere where there's kind of tourist destination, that's really been picking up. I think what's going on here is that risk ratings, particularly risk rating upgrades, really are sometimes slow to adjust and just might take some time for these favorable trends to distill their way into the PD estimates for industries like transportation and accommodation. Now, of the 5 best industries on the right-hand side of this slide, the one that kind of stood out to me again was that finance and insurance industry, NAICS 525 funds and trusts. If you recall, that industry had a really sharp uptick in past dues from March to April, and yet its weighted average probability of default is among the best of all the industries in the database. That's a little bit surprising. Again, recall that borrowers in these industries, that might include private equity firms and financial entities that specialize in leveraged lending. The past due increase that we're seeing for this sector could be an aberration. I am a little bit concerned, though, that rising interest rates could perhaps deteriorate the credit outlook for this particular industry. So I'll be interested to see whether or not 3 months from now, 6 months from now, the weighted average PD for funds and trusts begins to deteriorate as interest rates begin to rise. Another good sector here, right below funds and trusts, is telecom. That tends to be a little bit more resilient towards in periods of stress. So I wasn't surprised to see that having such a low, or said another way, a favorable weighted average PD in the month of April.
Thanks, Jeremy. We're now going to go ahead and do another poll question. So I will be launching it right now. The question is, how would you compare your bank's overall, oh wait, this is not the one I meant to, that's not the one I meant to do. Here we go. Okay, given signs of a slowing economy and persistent inflation, how would you describe your bank's current underwriting standards for commercial loans? Either we are loosening underwriting standards, tightening, or making no material changes. So I'll give everyone another 30 seconds or so to finish that. And once we're at a little over 50%, we'll go ahead and end the poll and share the responses. Okay, we're at 60%, so I'll go ahead and end it and share those results. So it looks like the vast majority of 60% are planning on making no material changes, 37% tightening, and a very small 3% loosening. I think often people don't necessarily want to say it when they're loosening. So that's possible that there are more people than that in there.
No, that's a fascinating trend, Carly, and I think that really aligns with what we're seeing in the marketplace as well. In particular, if you had a chance to read the latest senior loan officer survey the Fed put out, that's basically this trend really echoes and reflects what we're seeing in those poll numbers. That a net share of banks reported um, tightening standards a little bit for certain asset classes. Actually, one though where the survey said they might be easing standards was specifically for certain types of CNI loans. And bear with me one moment. Looks like the PowerPoint may have frozen. There we go. And so what we're doing here, we want to basically have a chart that would show you, help give you some color into whether or not banks might be loosening underwriting or pricing standards for commercial loans. What we've done here on the left, we've plotted a chart designed to show you how in broader debt markets, entities are pricing for credit risk. So this is the left-hand chart is the yield difference between triple B rated corporate bonds and 10-year treasuries. And what we found is that from year-end 2021 to April of this year, the credit spreads actually increased over time. So that means that perhaps in the bond market or broader debt markets, uh, there is maybe a higher premium, if you will, for risk that could reflect maybe that the economy is slowing and bond investors are demanding a higher return for the same level of credit risk. We're not actually seeing that same phenomenon take place for CNI loans. So even though the net majority of our respondents said either they're not changing standards or they're actually tightening standards, what we saw in the marketplace for CNI loans is that for new renewed CNI deals tied to SOFR, which is now the leading index in the CNI space, spreads actually came down from December to April. So it's the opposite of what we're seeing in the bond market, and just taking at face value might indicate that standards are loosening. Now, I think there's really actually another dynamic here that's important to mention. It's not that banks are not taking into account the headwinds that we're seeing in the economy. It's not that they're materially loosening underwriting standards. I think what this chart on the right really reflects, the reason we're seeing spreads narrow on CNI deals year over, or narrow quarter over quarter, is that competition in the marketplace is really, really intense right now. Non-banks in particular have gotten really aggressive with term structures, offering low fixed rates. That's put a lot of pressure on banks to price more competitively in order to win the deal. Some areas of the country are exceptionally competitive. We hear in like markets such as Los Angeles and New York, pricing competition is very intense. So even despite some of these headwinds, maybe the pressure to tighten credit, with the competition in the marketplace, and I think a lot of CEOs' desire to grow loan volumes after a pretty tepid 2021, that is putting some downward pressure on spread. Note, though, that it still is a rational curve. If you look at the slope of price across the risk rating spectrum, it's still sloping upwards. So we're not seeing anything too crazy there in terms of irrational pricing or anything that doesn't make sense. But spreads have come down from the start of the year, and I think that really reflects just how competitive the market is and continues to be. So next, we'd like to examine some of the major themes and trends in the commercial real estate market. And we'll begin once again with an examination of loan growth. And I admit here the chart is a tad busy. It's a very good chart, but there's a lot going on here. What it's doing, each color is a particular loan type. And then we look at the median growth rates for each loan type broken out by bank categories. So you can see on the x-axis, we group the banks by asset size. I'd point your attention to two colors in particular, those being the yellow bar on this chart, which symbolizes commercial real estate loans, and the reddish bar at the end, which is the total loan growth for the bank grouping in question. What we see is that for every segment except for banks under $100 million in assets, median loan growth was positive through the first quarter. Again, that's a really good sign. And what we're seeing is that for most of these banks, commercial real estate, that yellow bar, was among, if not the leading driver of that growth. This chart also breaks out multifamily lending, which is the pink bar here. And what we saw is for banks over the $3 billion asset threshold, multifamily was a major contributor to the uptick in the first quarter loan growth. This has been a trend for a while now, and I think a reason for that is that rent increases have really driven growth in the multifamily space. In fact, in today's rising rate environment, rent growth is to some degree a counterbalancing force to the higher interest rates. Multifamily also has a reputation for being or operating well through market corrections. So right now with inflation being so hot, that tends to drive more people to rent. And in turn, that drives up demand for multifamily developers and operators. So it might actually be a very good segment right now to continue to lend to, given where we are with the inflation running so high. The only headwind I really see in the multifamily segment is environmental regulation. We're getting a lot more questions about ESG. I know the SEC has put out some new rules on disclosures and how that might impact building in this space. That could slow down some of the growth in multifamily in the multifamily sector if that regulation is perhaps becoming more stringent or it begins to take off. But really, other than that, I continue to see this. I would anticipate that multifamily lending will continue to grow at a rapid pace in 2022. So here we give you some more insight and color into the major contributors to CRE loan growth broken out by even more property types. And what this chart is plotting is each shares for each property type, its share of the total CRE outstandings in the CRN database. And you can see that there's two property types here that saw a pretty big uptick from year-end 2021 to April of this year, and we've highlighted those with the green arrows, those being the industrial segment and multifamily. Multifamily did go up, but actually the larger increase over the last 4 months has actually been seen for the industrial segment. Industrial is really a bright spot and one to watch because of just how integral it is in the supply chain system in the US. According to Moody's, sectors like both multifamily and industrial should continue to post good returns for investors and operators in 2022, even despite some of the headwinds, the economic headwinds that we've mentioned throughout this presentation. There was actually a survey done. I don't have the source with me at the moment. I apologize for that, but there was a survey conducted where they asked underwriters, which types of properties are you most excited to underwrite and originate? And by far, the most popular answer was the industrial warehouse segment, the least popular being office and retail. I think the reason for that is industrial, probably more so than any other property type, really is maybe easier to build. There might be some less red tape there. They might be, you can build them in lower zone parts of town. There's less fighting from neighborhood associations. And so I think that's been in many ways a reason for why it's been increasing at a pretty rapid clip over the last several months. Now, if you look here in this chart, the segment where the property type with the most outstandings concentrated in it is office, although office really hasn't been growing all that much over the last several quarters. Office is a bit of a different story in terms of its outlook. A real big concern for office at the moment is that the amount of office space listed for sublease really is on the rise again. So that had come down during the second half of 2021 when companies were starting to reopen, people were starting to come back to the office. But then after Omicron hit, this trend actually is on the rise again. There was actually an article a few days ago in the Wall Street Journal titled "Office Building Owners Drown in a Tide of Sublease Space." That's a bit hyperbolic. I wouldn't have maybe used quite the same terms, but it does kind of speak to the trend that with all of this sublease or all this sublease increase that we're seeing for the office property type, that really is a concerning trend for the outlook for this particular property types. And with hybrid working models, with people continuing to work from home, maybe only come into the office once or twice a week, there may not be enough tenants to absorb all of this space that we're seeing for office. So definitely a concerning trend and one we really have to monitor closely in the months that follow. Now, earlier we examined delinquencies and non-accruals for C&I loans, and here we present a similar picture for the CRE portfolio. What we've seen, if you look on the left-hand chart here, is that short-term CRE delinquencies, they did increase a little bit from March to April, though not nearly to the same extent that we had seen for the C&I portfolio a few slides earlier. It's also worth noting that with the exception of that one big spike at the start of the pandemic, CRE delinquencies have not been nearly as volatile as we've seen in the C&I space. A bigger headache, though, for CRE loans is what we're seeing on the right-hand chart for non-accruals. CRE non-accruals are still pretty elevated relative to the pre-pandemic average. They're north of 1%. That compares to a pre-pandemic average of 0.3%. So we're still way above where we were several years ago. A big reason for this is the lodging property type. Lodging was really stressed throughout the pandemic period. In fact, I think at one point in 2021, non-accruals made up nearly 10% of lodging-related CRE loans, no doubt due to travel restrictions meant to curb the spread of COVID. The sector is coming back, but non-accruals in the sector are still really, really elevated. In fact, if you take lodging out of the mix and look at the overall CRE non-accrual rate without lodging, it drops more than 30 basis points to 0.72% in the month of April. So it really just shows you how much of a headache this particular sector is in the commercial real estate space. So here we can show you that trend a bit more explicitly. We're looking at non-accrual rates year over year for the major property types in the database, including lodging. And lodging, as discussed, is really a sore spot. You can see we had to actually break the y-axis here to plot the non-accrual rates for lodging. Good news is the problem loans in that industry are coming down at a pretty rapid clip, still really elevated, but at least they're trending in the right direction. By that same token, we're also seeing pretty strong improvements in retail. If you look on the far right there, the non-accrual rate for the retail sector really did improve year over year as well. So that's a good finding. The one that caught me by surprise a little bit is that non-accruals for office are still incredibly low. They increased a little bit year over year, but they're well below or far better than the average for the CRE market as a whole. It's a little bit surprising. Again, the one reason I say that is in the CMBS market, more than $2 billion of loans are against office properties that within 1 year face expiration of leases governing more than 25% of their space. And as an anecdote, I heard that in Manhattan, just 8% of office workers have actually returned to the office. So these headwinds to office really could soon create more problems in the form of delinquencies, non-accruals. If more people are not coming back to the office and more sublease, more companies are trying to sublease their space or maybe not renewing their leases, again, that's a major, major risk for office lending and for banks that have material exposure to that particular sector. Now, to take a contrarian view, at the same time, social distancing does offer companies a chance to reimagine their office space. We've been hearing more examples where companies are creating what you might call more space for common areas where employees can socialize, collaborate, work on projects together. Even social distancing might just mean separating more cubicles. That could create a need for space and potentially counterbalance some of this trends that we're seeing with fewer people coming to the office and maybe at least right now, a lower need for space. So a lot of different things to unpack here in the office sector, certainly one we're really going to pay attention to very closely. Hopefully the latter, with maybe more creative ways of utilizing that space, will allow this particular sector of CRE to continue to prosper in terms of non-accruals and delinquencies. Now, much like we see when segmented by property type, non-performing CRE loans vary widely by geographic region. This chart here, it's a little bit more complex, but what we're doing is we're trying to get a sense for the level of problem loans, level of problem CRE loans, that is, in each geographic region, along with the percentage of loans that have the potential to become problems later in the year. So the blue bar is the percentage of CRE loans rated special mention. That blue bar, the dark blue bar, does not include special mention loans that are past due or accruing. So these are still performing loans, but they're risk rated poorly and have the potential to become delinquent in the months that follow. And the yellow and the light blue series plot the percentage of CRE loans that either already are past due or on non-accrual. So it shows you the delinquencies in each region and the loans that have the potential to become delinquent in the months that follow. The good news is that at a national level, if you look at the pair of bars on the far left, the percentage of loans that are delinquent or a special mention did decrease year over year. So that's a favorable trend at a national level. A notable exception is the Eastern Midwest. This industry not only has a much higher percentage of problem loans, problem CRE loans, that is, but it's trending in the wrong direction. The level of special mention loans and loans on non-accrual both increased year over year in the Eastern Midwest. We looked into that, and a big reason for that is compared to other regions of the country, the amount of lodging loans that make up the Eastern Midwest CRE outstandings is very, very high. And I think it's lodging in this region that's really responsible for the trend that you see there. In terms of COVID restrictions as well, some areas of the country are what you might call more lenient than others, which has implications for not only lodging, but retail and maybe some other more volatile forms of CRE lending. All of that can account for some of the disparity that we're seeing here across the geographic regions as well. For banks that subscribe to our service and that have our online CRN dashboard, they can filter their peer comparisons just for their footprint, just for their geographic region. That way, they can filter out some of this volatility and always make sure they're getting an apples to apples comparison. So to summarize some of the major trends here, again, we are seeing some macroeconomic headwinds intensify, and that could have some major ramifications for C&I and CRE asset quality in the months that follow. The good news is that right now, businesses, perhaps feeling inflationary pressures, perhaps for other reasons as well, really are borrowing at a rapid clip. For CRE, that's been really strong in multifamily and industrial. Office is not growing, and again, it's a sector that we really have to watch out for, but multifamily and industrial are doing very well in terms of loan growth. And again, with the real notable exception of C&I delinquencies, commercial loan asset quality is really strong. Criticized loans through the month of April are at a really low level. PDs for most industry, probabilities of default, that is, are also favorable. So despite these headwinds, asset quality is still very strong. Again, that one exception is that we did see short-term C&I delinquencies spike at April, or at the end of April. Wouldn't make too much of that just yet, but it's definitely something that we here at AFS and RMA are going to pay attention to very closely. And in particular, that spike was reflected in the finance and insurance sector, which again is a real big exposure for many of the banks that we work with. And then for CRE loans, lodging is still a sore space or sore spot in that particular area of the market, as is office to a certain extent. We're not seeing office non-accruals or delinquencies take off just yet, but with all this, with all of the percentage of office loans that are coming up for renewal soon, where perhaps borrowers are not going to renew their lease, that is a major headwind in that particular sector of the market. So Carly, I know we're coming up on our hour. It was certainly a lot to share this month. It's been a real interesting month trying to dissect the economic trends and seeing what their impact is on commercial loan asset quality. So I think we can now take a few moments. I know I see a few questions in the Q&A and chat, we can take a few moments to answer the audience's questions.
Yes, absolutely. And please continue to send questions if you have any. So I will go ahead and start off. Jeremy, we have one question that is asking, we are seeing a conversion of office to multi-use at reduced values. Is there a way that you will be able to track that conversion of use and the amount of reduced value?
Juanita, that's a great question. The analyst here that specializes in this service, Tom Cronin, who usually presents this webinar, I'll touch base with him to see if we could begin to track that. But that's a really interesting trend that you point out. Again, maybe going back to a way of trying to reimagine office space that we're seeing. So great question. We will get back to you on that particular one.
And another question of where can I find what states are included in each geographic region?
Oh, sure. Kelly, at the end of the presentation here, we have a map that illustrates, I think I just went to that slide. This would illustrate here at the end of the presentation what states comprise these geographic regions. And I should note that if you subscribe to our service, we can create customized footprints for your bank based on MSA and state levels. But these are the ones for this presentation that we used for some of the geographic charts.
Another question about breaking things out. Is there a way to break out the CRE office between downtown versus suburban submarkets?
Andrew, we can look at the results at a CBSA level. Trying to drill down a little bit further than that. I think we've done some analyses like that before. One thing we do in the service is we try to map all of the bank's data to standardized categories like MSAs and states and regions. And I think right now, most of the analytics are centered on different MSAs and cities, but it's a great suggestion and one that I'll take back to our development team.
And another question, on slide 8, you showed loan growth pulled back last year. How much of that was due to PPP forgiveness?
Yeah, great question. The PPP runoff certainly contributed to, because this chart here does include PPP loans. A good bit of that was because some of the PPP balances ran off. But even if you exclude PPP loans, for much of 2021, growth was very tepid. It picked up at the end of the year. December was really strong. Banks for a while had highlighted strong pipelines. And I think we finally saw that start to materialize at the end of 2021. What I think the big takeaway here is just how robust growth has been in March and April. That has been almost entirely due, I think, due to the inflationary pressures, but the retrenchment that we saw in 2021, even if you take out PPP, C&I balances as a whole were down for much of the industry during that time.
Right. And a question that kind of shifts gears a little bit, but do you have any insight into what alternatives to LIBOR banks are choosing?
Oh, great question. So we had a trend or a chart here where we were looking at spreads tied to SOFR loans. That has become the leading index both in the bilateral space as well as the syndicated market. We're seeing, I think, at least 50% of all new C&I and CRE bilateral volume is now tied to SOFR as of April. We're also seeing a bit of a pickup in BSBY. Ameribor, for some reason, hasn't been quite nearly as popular, but SOFR definitely is now the leading index and leading alternative to LIBOR, followed by BSBY, and then to a much lesser extent, Ameribor. Interesting, too, that some banks have actually been using the prime rate as a temporary substitute. We've seen for some banks, they're actually booking prime loans with negative spreads to make them more LIBOR-like. So it's really quite a bit of a disparity and what's the word that I'm thinking of here? Diversity in the marketplace around the alternatives. But SOFR is definitely the leading alternative and the leading index for C&I and CRE loans.
And next question is the 2022 loan growth due to new loan business, increasing line of credit utilization, or a combination of both?
It's a combination. We saw both new lending take place as well as banks tapping credit lines. In fact, it was actually an interesting dynamic. Line utilization did go up from March to April, it actually would have gone up further, but some banks actually increased credit lines for some borrowers, which muted that effect. But it is indeed both an increase in new volume and some customers that already have credit lines tapping those credit lines.
And finally, unless anyone else slips a question in there, is there any Canadian data included in this?
Good question. This is primarily a US bank data consortium. The majority of our participants, some participants do have exposure in Canada, but it's primarily comprised of US banks that operate primarily in the US.
Great. Well, if there are no more questions, I think this is one of the ones that's run the longest. That was absolutely fantastic, Jeremy. Thank you so much for sharing your insight. And thank you to everyone for joining us today. We look forward to having you at our next session on credit trends. Also, if you were unable to join the live demo for the new user phase of Credit Risk Navigator that we did a couple months ago, make sure you watch that on demand by visiting rmahq.org website. We had a great conversation about the new platform and how you can use it in real-time scenarios. This concludes our webinar. Please take a moment at the conclusion of the event to complete the post-webinar survey. Thank you, and we'll see you next month.
Thank you all. Thank you for joining.
Thanks, Jeremy.